Are you bullish on cryptocurrency, or more specifically, HEX? And do you know what a call option is? Where you can take a leveraged position to actually benefit if the price goes up. If somebody's very bullish on something, they can take a leveraged position, which just means that they get to amplify their returns if their bet is correct. Well, what if you could create this type of payoff? We're going to get into the details of this, but you didn't actually have to pay for the premium like you do in a call option. So in a call option, you pay a fee, and then in the future, you have the ability to just get all of the gains from that option, right? So you might pay a small amount, or, depending on where you want the option to be, right? You might pay a larger amount, and then the profit is unlimited, and you know what the max loss is on that position. So I actually figured out how to create a call option that you own where you don't have to pay for it today, but you get the same payoff. This is insane. Now, if you understand crypto and you understand call options, I guarantee there's nobody else on YouTube or the internet talking about this. So if you want to be in the front edge of like what's happening, stay tuned. But first, if this is your first time here, what's good? My name is Sam, and for those of you who are returning, it's good to frickin' see you. Now, we're going to talk about call options going along. What does that mean? It just means owning the call option. So I drew up this diagram here. Thumbs up for how awesome my artwork is. This should be an NFT, right? The way to look at this chart is, we'll start over here. This here is the profit of a position. So this here in this center point here means that this red area, I'm losing money, and in this green area, I'm making money, right? And down here is the share price. So this, in this case, say HEX. Well, this example would be like a stock or something, right? But if the price is down here, I lose money. If the price is up here, I make money. Now, in the traditional world of owning or long a call option, this max loss that the arrow is pointed to is the premium that I pay. So you purchase a call option, and that there's options in business that people purchase. There's options in insurance that people business. There's options in contracts perpetually. These types of things are very interesting. And if you understand how options work and like option pricing theory and stuff like that, well, you don't have to understand that completely, but like you got to understand a little bit how this stuff works, because then you can start to utilize this kind of thing in your life to take advantage of asymmetric returns. This is the maximum amount you can lose, is what you pay for it. But the potential for gains is substantial, right? Like you can only lose this amount, but you can make this just goes on and on. You can make a lot more to the fucking moon, right? And now I'm not recommending anybody do what I talk about in these videos. This is fucking advanced shit. Like you shouldn't do any of this stuff unless you really understand what you're doing, and you're completely okay with losing whatever money you put up for this, right? And remember, the beautiful thing about this, which I'm going to get into in a second, you don't have to put any money in to start with, which is insane. This is like a free option, and you'll have to pay for it in the future, potentially, which we'll get into in a second. But you can set up a option for free, which is, so when you think about like economic theory, and to be able to own an option that you don't have to pay for is insane, right? Because if you think about economic theory, the theory goes along the lines of, if there's an option in a contract, in a business deal, in the financial markets, the participant who owns that pays for it, right? Now, the participant who is selling that option is can not be aware of it, or the market could be mispricing that, right? And in this case, it is 100% mispricing. This is insane. This isn't freaking cool. Now, this BE here, this is the break-even point, right? So the price per share has to basically be right here for this to be break even. So now let's go through what we've actually gone through and created. Now, if you saw the video yesterday, this is what got me onto this track. So this here, we'll just run through this quickly. If you want to see way more in depth on the details of this, you can check out the video from yesterday. But say you have a credit card that has a $20,000 limit here. You can get the cash out by 3%, and you can do this by a cash advance, or you can do this by, like, I own a business and I can charge myself $20,000 on the business, right? So it's personal. I got my card, right? And I charge my business 20 grand. That means the business that comes off of the card and into my business, and I get $20,000 cash, right? So in either way, it's about a 3% fee you're going to pay. But then you're like, whoa, you're going to get raped on interest charges. Well, we're going to get into that, right? So the cost on this is just 3%, right? That's a cash advance fee. The cash I'm going to get is $19,400. The credit card balance is 20 grand because I took out the full amount. The payment factor is 1.5%. So my payment every month is going to be $300. And you may be thinking, I thought you just said you didn't have to pay for this. Well, just calm down. Hold your britches, sonny. So $300 a month. Now, we're going to take a reserve from the cash that is somebody else's cash, right? The bank's cash. We're going to take the payment for the next 20 months. 6 grand. So we're going to take 6 grand, set it up in a separate checking account with auto pay. So this is automatically paying the bill every month for us. So we are not paying for this. This is the cash that is coming from this credit card. But then you're like, what about the payment is going to be extremely high in terms of, excuse me, the interest rate is going to be extremely high. Yes, we're going to get to that. So this is how much cash is left, 13,400. So we're gonna take this cash and we're gonna do a balance transfer. So that's what this is actually. This is a balance transfer to a card where there's plenty of options out there where you can transfer your balance for 0 APY. So you're effectively borrowing 20 grand for 600 bucks, right? And you want to do that right away because once you do a cash advance well, depending on how you structure it. If you do a cash advance, it's going to be daily accrual. If you do it through, like, I charge myself, my business 20 grand, then it's going to be like the traditional, where it's periodic every 30 days that you get charged interest. So you could actually extend this to like 21 months, or you could even draw this out to 30 months if you're like, this is not appealing to me in this risk profile. And so 20 months in the future, you can do 30 months in the future, and you just roll your balance again. Okay, so we bring this over to Coinbase. We buy 13,200 of USDC. We buy 200 bucks of ETH. The current HEX price is 13 cents, 14 cents almost. That gives us 96,000 coins, right? We stake that, and I did not even factor in Hedron because Hedron's so trivial. Like, Hedron has to have like 1,000x for it to be like $7 or $10 or something, like, so I didn't even take the time to put that in here, but I did look at it. So we take our coins and we stake them for 109 days, right? Now we get another 22,000 HEX, right? So now this is time equal to 20 months now. So we set this up today, April 8, 2022, and now we're in 2024, right? And we haven't done anything. It's been on auto pay the entire time. We haven't done anything at all. And we could have even taken, split this 6,000 up and done like 3,000 and another $3,000 stake, right? If we really wanted to get even more complex, but let's keep this super simple to illustrate how we can actually create this type of payoff where we know this amount, but we can get this asymmetric return, right? Well, at time equal to 20 months from today, we have a total amount of HEX in USD terms, which is this is the old price, right, at 13 cents. So 95,000, 96,000 HEX plus what we earned plus the 13 times the 13 cents, which currently, if you look at nomics, it's currently 13 cents. So we're at the end of this, we have $16,000. The credit card balance after we paid down the $6,000 using their own money to pay it back is $14,000. So if you look at this, HEX price doesn't have to do anything at all, and you make $2,000 profit for about an hour worth of work. And you didn't think you could get paid $2,000 for an hour worth of work. Well, now, where do you think HEX price might be in 2 years? Say 100. So I put down $1.50, right? I had no effing idea whatsoever. But let's take a look at this payoff. And the price of this can actually come down, right? So if you look at this, the price of this can actually come down to, I forget what it was. What was this or something? Roughly, yeah, to 11.8 cents. And then it becomes a break even. So let's take a look at our chart here. I drew up another one, right? So this is the same exact thing right here, right? Just a little bit cleaner looking. We set this up. The maximum loss in this example is $14,000, right? So let's write that out. 14K. That's the maximum loss. And I did another example. I'm not going to run through right now, but if $14,000 seems like a lot of money to you, first of all, don't do what I'm talking about in this video. Second of all, if you're like, oh, this seems super cool, super interesting, I'm going to dive into this, and it's okay if I lose money, right? Because I fuck something up. Well, there's an example here that I did for $5,000, right? So $5,000, you can do the same thing. The numbers are just slightly different. You don't have to use $20,000. So $14,000 is the max loss. This is what you would pay for the options contract. However, you don't have to pay this until this date. So you get to sit on this option for free. Does that mean that at any point between now and the next, 20 months, there's a bull run in crypto, right? And the what's called could be substantially higher. Another thing this does, because we actually take the capital and we invest the capital and earn a return, right? There's a earning or a yield with HEX. Then what happens is we actually drop our break even from 13 cents. Remember, HEX is currently 13, 14 cents, right? Down 2 pennies. So from 13 cents, well, basically 14 cents to 12 cents, roughly ish, right? So we're able to reduce our break-even point because of the interest that we're earning. And this is what the payoff looks like, right? So if, say, HEX is $4, you get 400 grand, right? If HEX is, 80 cents, you're $94,000, right? And just remember, this is 2 years away. If it's $1.50, you get $162,000 profit. This structuring like this allows you to get this option for free for the next 2 years and have the capacity to earn this. So this is the option portion of it, right? Well, what if some crazy shit happens and it's $10, right? A lot could happen. Look at the last 2 years. What if it was $10? You just got $1 million for somebody else's money. For somebody else's money. This is insane. Nobody else is talking about this shit. Nobody. And if you find this stuff interesting, let me know down below in the comments. I would love to hear your thoughts. Also, take a second, share this with somebody else. I'm trying to grow the channel. Appreciate your help. If you found it interesting, if you found this valuable, if you found this insightful, share this with somebody else who you know in crypto or you know who likes options. And hopefully they'll find this interesting or helpful as well. If you want to reach out, you can check out Twitter down below or Instagram down below. If you want to support the channel, there's also Ether address down there as well. Or a couple other links. So I appreciate you guys. Talk to you soon. Peace. We got some good stuff coming tomorrow too. Wait until you see tomorrow's video.